Well, I think we can all agree that Disney is in trouble. That their series of bad decisions, bad investments, and bad public relations have put them through a social-economic nightmare. However, unlike every other YouTuber and Phantom Menace are out there covering these social scandals in exhaustive detail, I'm going to ask a critical question. How does this actually affect Disney as a company? Now, the thing you have to understand about a company is that it is an organization dedicated to enriching stockholders' equity, making their owners money, their shareholders money, and continuing to do so. Because of this, public outcry and scandals can sometimes not even dent a company's profits. We've seen this, for example, in Marvel Comics, with their increasingly deplorable sales due to bad writing and political pandering. Yet they keep on publishing these stories despite the public outcry. Why? Because as a subsidiary to Marvel Entertainment and Disney, these losses are acceptable as there are other, more substantial means to make equity. Which brings us to the critical point. How well is Disney doing financially amidst these public scandals and failures? Now, to those who don't know me personally, I am pursuing a bachelor's degree in general business management at my state university. Because of this, I have taken classes in economics, business law, accounting, marketing, operations, and as of this ongoing semester, finance. So, I know how to read a financial statement of cash flow, and income statements. More importantly, I can make an educated analysis based on this information and tell you how well a company is doing based on 3 specific factors. The first is their shares outstanding. While not a clear indicator on its own, comparison of shares outstanding over the years tells you the decline or increase of how many shares that company owns, which can in turn relate to current events inside the company. As you can see from this screenshot, Disney's shares have shown a consistent decrease since 2015 and beyond until June of this year. However, I should stress that the first 3 years are the sum of their annual shares, compared to 2019, which is only a calculation of the most recent quarter. Like I said, not a clear indication of their success or failures, but it can be an indication of what's going on in the company. More on this in the next point. The second is a correlation between their current stock price and their dividend yield, or the sum of money paid regularly to shareholders out of company profits, divided by their stock prices. When stocks drop, the ratio will rise, and when stocks rise, the ratio drops. As you can see from these 2 screenshots, we once again see a sudden spike in stock prices, especially when compared to their typical stock average over the past several years. This is also reflected by their sudden drop of yield. Interestingly enough, none of Disney's subsidiary companies provide any actionable information regarding their own stocks or finances, save for one, Marvel Comics. As you can see from this screenshot, however, its stocks match Disney's almost exactly. So, Disney's financial information is not just a reflection of the Walt Disney Company itself, but of the companies it owns. So, by now you're probably asking if Disney is doing well or not. The answer, despite appearances, is no. My third observation reflects this as according to the balance of their market capitalization and enterprise value. Market capitalization is the overall sum of their shares outstanding, and is in turn a reflection of their equity, cash, and liquidity values, or how much that company is worth on the market based on how much they make. Enterprise value, on the other hand, is a market value based not only on liquidity, but their liabilities, debts, and expenses. Accordingly, if the enterprise value is greater than the market capitalization consistently, then that means the company has more debt than cash and is financially not doing well. For Disney, this is the deadly truth, as when you compare the 2 values, Disney has more liabilities than equity since 2015, and 2019 marks the worst point for the company. Because of this, why does Disney still have such high stocks and shares? Typically in such times, the prices of stocks would be lowered to encourage more investment, but instead, Disney has continued to keep the price at record high, with their shares outstanding likewise rising instead of falling. The answer may lie in fraud. In recent months, ex-Disney accountants have reported that Disney has inflated its revenue by billions in order to make up for rising debts. By this understanding, I believe this fraud can also be extended to Disney's strange stock history. In short, they're overvaluing their stocks in order to keep their shares high, and in turn, hold on to their shareholders. This becomes doubly clear when we understand that all Disney subsidiaries, not just Disney itself, are tied to stocks, assets, liabilities, and shares of the mother company. Disney is inflating their numbers in order to prevent their subsidiaries from potentially leaving. Another company going through a similar issue is Target, one I did a project on recently for my finance class. As you can see from the Excel screenshot, it too is suffering from the same issues of debt to equity as Disney, but unlike them, has lowered their stock prices and shares to compensate. So, what does this mean, dear viewer? It means that Disney is in serious danger of fracturing to pieces. Either the subsidiaries of the Dream Empire will buy themselves out of contract, or be sold by Disney itself to prevent the company from going into bankruptcy. I feel this is reflected in the unfavorable deal Disney took with Sony to get Spider-Man back in the MCU, Captain Marvel falling out of favor and once again being sidelined, shakeups in Lucasfilm's management bringing over MCU directors and managers, and J.J. Abrams attempting to distance himself from the damage caused by Rian Johnson. In other words, Disney has become a sinking ship, and it may be time to get off.